Hello and welcome to week 12 of the economics of cryptocurrency. The first things I want to tell you guys about is I've decided that the final exam will be open for 10 days from April 13th to April 23rd. I put a note about that in the current version of the final exam announcement in the Canvas page. When I actually write the exam, that will be replaced with the quiz. That's actually the final exam that you again need to go take at any Weber State Testing Center. That's why I've decided to open it for 10 days. Make sure to take a look, and I'll include links about this when I leave announcements about it. Take a look at their hours again, just make sure that you'll be available to take that final exam. I won't be able to extend it past the deadline this time. So if you have any conflicts, you need to take it earlier in the time, just because April 23rd is the last day of finals week. Please let me know if you have any questions about that. This will really be, I'm going to do one more lecture video next week. I'm going to talk about some current topics in cryptocurrency. But for your collab assignment, I wanted to give you a heads up about that. I'm going to have you go back and basically edit or do whatever you want to do to any of our previous collab assignments. So you can pick one all on your own. It's going to be very open-ended, but you'll just have to pick one, talk about what you're going to do to change that or update it in really any way that you want. But you'll want to motivate that, why that's interesting to you. So I just wanted to give you a chance to start thinking about that now, and then that'll give you 2 weeks basically to think about it as opposed to just the 1 week. So let's jump into today's lesson, which continues our economics of cryptocurrency paper, the microeconomics of cryptocurrency, which you have available to you again on the Canvas page right here. So hopefully you took a look at that last week, but remember that's in week 11 materials, the microeconomics of cryptocurrency. Last time, what we showed were things like optimal mining, like what choice of computational power will a miner choose given costs and stuff. We basically did the basic microeconomics of how much should I produce in terms of how much power should I put towards mining. Should I be in this market at all, or should I bail from this market, basically? Now, that second condition is called the participation constraint, and that actually becomes a part of this problem right here. So the cost, the total cost of mining, which is the number of miners times the cost that they're putting into the network, needs to be less than or equal to the exchange rate times the block reward. We're kind of assuming away transaction costs, but we could think of transaction fees that people making transactions on the blockchain voluntarily make. Those would be part of theta, or you can just think of theta as the fixed block reward, like in a Bitcoin network. But we did talk a little bit last time about how that's supposed to go to zero at some point. So really that needs to be transaction fees. So let's just think about what we're doing today is moving beyond what individual miners will do when they interact with the blockchain. And we're thinking about how, given how they will behave when they interact with a blockchain, what is the best way to design a blockchain? So this is referred to as efficient or optimal design. So how should a blockchain choose rewards and resource use to minimize waste while still keeping miners willing to participate and attackers unwilling to attack? Because we really want to have an efficient system, but how we design that system will also dictate the degree to which people participate and the degree to which attackers want to attack the network. So in the efficient design section of the paper, so you can read along with this in the paper and see very similar to math, but to what we're talking about today. So we're going to minimize the cost times per miner times the number of miners. That's the total cost of the blockchain that we're thinking about designing. As designers of the blockchain, we can sort of choose the cost because we can choose, well, how difficult are we going to make the proof of work problem? And that will dictate partially the cost. How the cost and the and the block reward interact, then will of course impact how many miners are willing to participate in the mining network. So these are the choice variables essentially to the designer of the system, and that designer would like to minimize the cost of the system. However, that cost minimization problem is subject to two constraints that we talked about last time. First of all, we do not want the system to be attacked. So one way to write the security constraint basically is to write A, which is how much power you need to attack the network. And then that's going to be relative to the number of miners, honest miners, and how much cost they're paying to attack. And we also saw that it's going to relate to T, which is how many periods until transactions are considered confirmed on the network. When that's longer, then it's harder for somebody to attack the network. So you can maintain the network at lower cost. However, some of your participants in the network probably don't want to wait forever. One of the benefits of something like Bitcoin is that transactions are settled or verified relatively quickly. And if we make T really big, then that's not true anymore. If we make T several days, then it's like, well, some people might say, I'll just go back to the regular banking system because the banking system settles in that amount of time. So we want this cost related to attacking to be greater than or equal to what we describe as the private value of the attack. That could vary by attacker. So we're kind of thinking of like, this is the maximum private value that we might observe for attack. Because if the cost is bigger than the highest private value, then nobody will want to attack the network. We're making this value explicitly dependent on the exchange rate, which will be important later in this collab. The exchange rate, you should think of the exchange rate of Bitcoin as the Bitcoin price, basically, in US dollars. It doesn't have to be in US dollars. If we were thinking about this problem from the perspective of somebody in Europe, maybe E is the exchange rate in terms of euros. But regardless, this is the exchange rate, and we expect the value of private tax to depend on the exchange rate. So that's one of the constraints that needs to hold when we're minimizing this problem. This is the reason we might choose higher costs, because when you have higher costs, this side of the equation gets bigger through things like C and N, because that's CN right there, right? So by having higher costs, we're essentially protecting the network. We're making attack less valuable. The other constraint is called the participation constraint. The total cost needs to be less than or equal to the exchange rate times the block reward. Otherwise, people will not want to participate with the network. Because if the cost of participation were greater than the rewards, essentially, of participation, then nobody would want to participate. So here, just as a reminder, N in all these equations is the number of miners on the network. We make some simplifying assumptions, or they make some simplifying assumptions about what those look like in the paper when it's useful. Like they're homogeneous miners, every miner is the same. That leads them to make the same choices. When we did our little simulation, we actually did, with miner A and miner B, that wasn't true. So we violated that assumption. That assumption is certainly violated in reality, but in terms of this paper's goal, it might be okay and reasonable to make that assumption. In the past, we've talked about mining pools and concentrated miners and how that in and of itself could be an issue. And that issue relates basically to this, because if a mining pool has large enough A, how much power do I need to overtake the network? Then they might actually be thinking, well, is it more valuable to attack the network than it is to mine honestly? C is the per miner resource cost of the network. Theta is the token reward. So this is like the block reward in Bitcoin, but also we could think of that including transaction costs, particularly in the future of a system like Bitcoin, where there will not be a fixed mining reward anymore. And that's an interesting sort of future topic and current topic to think about. What will that system survive that transition to a no block reward and all very voluntary transaction fee type situation? E is the exchange rate in dollars or euros, depending really just on the context of who we're thinking about. The private benefit of attack. A, which is a number greater than one, which we talked about last time. How much larger the attacking coalition must be than the honest network? So if that was like 1.1, that means the attacking coalition, which could be a group of miners, a mining pool, would need at least 10% more power than the honest network. And then T, of course, as we mentioned, is the confirmation period. The main result of this problem is we can do math to basically solve this problem, is that efficient design gives that theta star, the block reward, should be equal to the private value of an attack over this cost, basically. And at the same time, NC star should equal the value of the attack over this same similar cost term. So that's just pops out of solving the math. So the upshot of it is that the design problem is not mainly about how many miners should there be. It is how much total resource use is needed to sustain the system and what reward is just large enough to support that level. So we want the reward to be high enough to just bring in miners to sustain that level. But then, of course, we want the reward to be low enough to just satisfy. So we want the reward to be high enough to satisfy this constraint, essentially, so that miners are willing to participate. But we also want the reward to be low enough, because no, this is subtraction here. We want this to be low enough so that it just satisfies this constraint. So we kind of want what's called a knife edge case where we just meet these guys perfectly, because this one essentially pushes our reward and our participation up. This one tells us push your reward and your participation down in order to not have wasteful mining on the network. So there's a trade-off embedded in these two constraints, which is important to recognize. So we can just play with those by setting some baseline parameters here. Let's make an exchange rate of 100, a private benefit attack of 60. We can make the attack multiplier 1.5, so that coalition needs 50% more power than the honest network. And then confirmation period of 6, which is what's the generally accepted confirmation period on the Bitcoin network. Although it's permissionless, so people could kind of talk about that in their own way when they would consider transactions to be confirmed. So then we can solve the efficient to design site situation. We know from the math that we want this constraint to bind with equality, and we want this constraint to bind with equality. And then that's actually how we get to those solutions that we mentioned above. So the participation constraint binds when these guys are equal, because remember, this had to be, less than E theta. So that would be a binding constraint if they were exactly equal. The incentive constraint combines if the cost of attacking is exactly equal to the value of attacking. And because those are a trade-off, both of them binding is going to be where our efficient design lives. And then, of course, we can do some substitution because we have common terms in here, play around with that, and then we get NC star equals this guy, theta star equals this guy, which is what we saw above. And then that's the paper's efficient design result, which is summarized above as well. Now we can compute those numbers given our setup right here, just plugging some numbers in. So we can compute the efficient design by just putting those equations into Python. So minimum total resource cost is NC star equals 20. Optimal token reward theta star equals 0.2. Dollar reward flow E theta star equals 20. Now, the E essentially has to be given. So if E changes, because that's the exchange rate and that's a market price, so we can pin down what E theta star needs to be based on what the optimal theta star is, and based on what these optimal numbers are, but we don't necessarily know if the market is going to respect this $20, there's 20, yeah, it would be dollars if we're thinking about E, the exchange rate in dollars. So that's really kind of important to think about because the market out there, we're trading Bitcoin. Some people are buying Bitcoin because they'll think it will go up in the future. Some people might be selling their Bitcoin because they maybe think it's going to be crashed. So basically, people are speculating on things like Bitcoin. But here we see that that actually is going to play a role in the efficient design of the system. And usually, if we go to the popular media and think about Bitcoin, it's like, oh, Bitcoin's doing good when the price of Bitcoin is very high, doing bad when it's low. But that's really somewhat independent of the efficient design problem. So the exchange rate that's consistent with efficient design may be quite separated from speculation in the Bitcoin market. And that's really important to think about because some people say to me, like, oh, well, Bitcoin stopped going up. So that basically means the party is over. Well, as we know from very early on in this class, if Bitcoin stays at a very stable level for a long time, that would be beneficial in terms of a lot of things we think about currencies. Also, maybe it's settling at an exchange rate that's more consistent with efficient design. So it's not clear at all that Bitcoin price changes that aren't great for what speculators want is not necessarily the same thing as the exchange rate that's consistent with a system that's minimizing costs and is blocking attacks. And so that's a really important distinction that I want you to have from this class is that when people in the popular media are talking about cryptocurrencies, they often are talking about the willingness and possibility of speculating and making large gains in those markets. But that is not when Satoshi released the paper that we said, they didn't say, well, we're designing this so people can speculate and make a lot of money off of it. Well, that definitely happened. That was not the motivation for designing the network. And that's something that I think is really an important takeaway from this class. They, at least in the back of their minds, had more ideas like this. We want a permissionless currency system that doesn't depend on trusted third parties. And this is more of the microeconomics of how that system might work and is really separated from the idea of speculating on the currencies that come out of such systems. So then, of course, we can check the constraints on this numerically, just plugging through some math here. So the participation constraint NC star equals 20, E theta star equals 20. We saw above that those would be equal at the efficient design point. So then the incentive constraint here is, so this binds, we need this to be less than or equal to this. They're exactly the same. So that's consistent with being less than or equal. They're equal. And then here's our incentive constraint that equals 60 at these numbers. Value of attack, we plugged in at 60. So the gap is 0. So this tells us that these constraint equations are consistent with the optimal solution. The optimal solution we found is consistent with both constraints binding, which in turn is consistent with the efficient design of the network. So based on this, we can visualize the feasible region of where where both constraints bind. And so let's look at a chart of that. So the incentive compatibility constraint, we want to be basically below the orange line and above the blue line. So this area, all of these points are feasible in terms of we're not having attacks and we're getting participation on the network. The optimal cost minimizing design then is going to be where those two meet. And this is the token reward that's consistent with that. And this is the total honest resource cost that's consistent with that. We could imagine going higher up to have a safer, if we were more worried about safety, maybe we don't want to purely minimize costs, but build in some buffer against attacks. And we could ride up the participation constraint line in that case. If we wanted more profits for our miners, but that would be a little bit difficult because of free entry, more miners will enter the network if we try to do this. We could ride up the orange line, give up safety for more profits for miners. I think the former would be more likely right up the mining curve to get more safety, the participation constraint curve. And so we don't necessarily have to choose this point, but this highlights this would be the cost minimizing point, that it's consistent both with participation on the blockchain and with no incentives to attack the blockchain. And so this is really the main result of the efficient design section of the paper. Now we can get into what economists refer to as comparative statics, is how do these things change? How does the efficient design point change with changes in the parameters of the system, like the exchange rate? And that is where the connection might be made between speculative investments and speculative market processes related to cryptocurrencies, like the price of Bitcoin and it being volatile, people making money on it, people losing money on it, with the efficient design system. So we can see that these two equations bind at this point. That's what's going on at this point. NC, that's the x-axis. Boom, right there. Theta, that's the y-axis. Boom, right there. So both of these bind at that point. So then we can think of some implications about this. Higher values of attack raises both the required total resource cost, because if this number gets bigger, then this number has to be bigger for this equality to remain true, holding the bottom constant. Now we could have, if we thought there was a higher value of attack, we could also have a higher confirmation period, and then that would allow us to actually keep this constant. Higher A, so if you need more computational power relative to honest miners to attack the network, then that lowers the required honest resource cost. So if A was larger, then this can be smaller. If I need to pay more to attack the network, then the cost of the network can be lower at the efficient design point. Higher T lowers the required honest resource cost because the attacker must sustain the attack for longer. We remembered an attack, or last time, remember that an attack occurs when a miner privately mines their own blockchain and is basically in a private race against the public blockchain. All of a sudden, if they would be successful, if they got their private blockchain to be longer, then they could suddenly publicly release it and other miners will latch on to that longer blockchain. Why? Because one of the rules is the longest chain rule. Why is that one of the rules? Because you need some way to get consensus on the network when there's potentially the orphaning of blocks. Hey, there's two valid blocks. What do I do? Well, A, mine one randomly. If a bunch of people do that, randomly one of the blockchains will get longer, and then the consensus is to go to the longest one. So an attacker could try to replicate this idea privately, all of a sudden release their longest chain. If that's a dishonest attacker, maybe they have transactions that are not valid on their chain, like giving themselves Bitcoin. So making that longer can basically increase the cost. So A and T are both about the costs of attack. If I need more computational power attack, then A is bigger. If I need to attack for a longer period of time, so I have to apply my A for a longer period of time, that's T. So when you have higher costs, you can have lower total resource costs. However, if the value of an attack gets higher, then you need higher resource costs in order to protect your Bitcoin network or your blockchain from an attack. The reward here, we could think about similar things too. Well, if the value of an attack is higher, then I can offer a higher reward. I need to offer a higher reward at the efficient design. And then that ties back into this, right? What is that going to do? That's going to attract more honest miners onto your network to get that higher reward, which will in turn increase this. So these really work together because you can pick theta to attract your costs, higher cost per miner, and more miners. So now we can think about, okay, we could compare different efficient designs given different values of A and T. So here's A is always 1.2. and then maybe T is longer. If T is longer, then the cost of the attack is higher. So I don't need as much computational power as T goes up to protect the network. And I also don't need as high as a reward. Here, where A is pretty low, T is very low, I need a lot of resource costs on the network to protect it. And so I need a big block reward to attract those miners and those costs to my network. However, as T goes up, the attack has to be longer. I don't need as many miners or as much of a reward to sustain my network. Okay, now A, if the computational cost is higher, then these are all shifted downwards. And of course, continue to shift downwards again as T increases. So this just shows how those and all those parameters interact, the costs of attack and what you need to do about that as the designer of the system. And trade-offs again, because we don't necessarily want T to be very high because we want it to be efficient network from the participant's point of view, those people trying to make transactions on the network to some degree prefer a lower T because then their transactions are settled faster. However, they don't really want such a low T that there's a danger to their transactions on the network. So these are the high meta sort of economic trade-offs that need to be thought about in terms of the design of any cryptocurrency blockchain. So then we can think about how does the value of attack change? So if value of attack is higher, the minimum total cost, of course, has to be higher. That's a linear in this setup. We could also think about how confirmations change with the total resource cost. So if I have a very high resource cost, I need a higher resource cost when I have a relatively low confirmation period. But having a high confirmation period, even when A is low on the blue line, so A is low, I don't need that much computational power to attack the network. So that means if a low T as well, I need an extremely high resource cost to protect the network. However, you can get a lot of gains by increasing the confirmation period because these things really go down fast in a non-linear way when I increase the confirmation period. All of these networks require a pretty low resource cost once I have a really long confirmation period. Now, exchange rate sensitivity is the one that's really interesting to me because there can be a lot of like crazy random speculative preferences happening in the exchange rate. You've seen directly how volatile Bitcoin is. It goes up wild, it goes down wild sometimes, and that has implications for this system. So, a really important implication is that the optimal reward may need to change with the exchange rate. This does not happen on the Bitcoin network. The reward on the Bitcoin network is all about participation. But then we see in the background, we have these massive swings in the exchange rate or price of Bitcoin. That has major implications. And these are the implications that when people talk about the price of Bitcoin, I see very little discussion about this aspect of that price volatility. So we know the block reward, or from the efficient design result, we know the block reward has this equality at the efficient design. So that, of course, depends on the exchange rate, but we haven't really talked about much about how the private value of attack depends on the exchange rate. And notice that we also have an exchange rate in the denominator here. Probably it's most likely that the value of a private attack is increasing in the exchange rate. Because if Bitcoin is super valuable, it's probably more valuable for me to attack the Bitcoin network. If Bitcoin's value is zero, it's hard to imagine attacking the Bitcoin network having a lot of value. So most likely the derivative of V, the value of attack, with respect to the exchange rate is positive. So increasing in E. On the other hand, the E is also appearing in the denominator of this. So when the exchange rate goes up, the cost of attacking goes up. Why? Because I could be collecting the block reward and I could be collecting fees And those fees and block reward I'm collecting on the honest network have higher value, and that's fundamentally the opportunity cost of attacking the network. So the exchange rate both can increase the value of attack, but also increases the cost of an attack, the opportunity cost. So that leads to some interesting interplay on how the exchange rate impacts efficient design of the system. So whether theta star rises or falls with the exchange rate depends on how the value of attack changes with E, of course. To make that visible in a simple picture, we use one convenient example. So let's just use this power function for our value of an attack. Then we can substitute here theta star now explicitly depends on theta. They're on the exchange rate. We moved the exchange rate over here now. So this is just a visualization dice of a broader point. So we're not necessarily clear that this mathematical function is true, but the broader point is what matters is the elasticity of the attack with respect to the exchange rate. So if alpha is less than 1, then theta star falls when the exchange rate rises. So that means that when the exchange rate is higher, you can have a smaller block reward, only though if alpha is less, or yeah, alpha is less than 1. If alpha is equal to 1, then theta star is constant with this. Because this basically doesn't change with the exchange rate if alpha happens to be equal 1, given this functional form we assumed. But then the other case, if alpha is greater 1, then the required block reward would increase when the exchange rate rises. So any of these could potentially be true. We don't really have our hands on how exactly the exchange rate maps to the value of tax. So that's a difficult question to answer, is which one of these is actually true. Maybe we could do an empirical study on if we could somehow measure the rate at which attackers were attempting to attack the network at different exchange rates, but we'd have to try to hold a lot of stuff constant, and that could be constant. That could be a very interesting empirical study. But as of right now, we do not really know what this sort of function looks like. With this assumption, we can go ahead and think about, okay, with different exchange rates, what does the optimal reward need to look like? Well, with alpha equals 0.5, we see that it actually decreases as the exchange rate increases. With an elasticity that's positive, we see that the block reward needs to increase in order to maintain the system. And then with a 1, it's just constant. It's a horizontal line, so that follows. That's just a graphical representation of these results here. We can see that it's concave, which is kind of nice, but that wouldn't necessarily be true for all functional forms we might come up with the value of an attack with respect to an exchange rate. So the paper highlights an important implication for Bitcoin itself. Bitcoin is designed so that theta falls over time, as we've seen. Supporters often expect the exchange rate E to rise over time. That combination is sustainable only if the value of attacks does not rise too quickly with the exchange rate. More precisely, sustainability requires the elasticity with respect E to be less than 1. So ideally, the elasticity is in this range where we can have a falling value of an attack, because again, the optimal reward token is falling over time. But again, the exchange rate plays an important and complicated role there. So basically, the lesson is that a rising token price is not enough by itself. What matters is whether attack value rises more slowly or more quickly than the exchange rate. So just a summary of what we've gone over here. The efficient design problem has a simple economic logic, lots of different trade-offs to think about there, and I'd like you to talk about in your collab assignment. A sustainable blockchain must satisfy both the miner participation, people want to engage in the network, but also needs to deter attacks. That's the fundamental trade-off in the problem at the beginning of this collab. Again, here there's a repeated main results, which we saw how those were derived above. N and C do not matter separately in the paper's result, but they do matter separately for reasons that we've discussed before. We don't want just one minor because then we would get into other issues like other different types of attacks to the network for one thing, but monopoly power essentially. We want competitive mining. A higher exchange rate does not automatically make the system safer because it depends on how the value of an attack changes with the exchange rate. And maybe some things about how the system was designed in the first place, like in the case of Bitcoin. So it is, what is the minimum total resource use needed to keep the system both active, participation, and secure, blocking attacks? So I hope that was insightful for you. Please do not hesitate to let me know if you have any questions. Like I mentioned, the final exam will be the 13th to the 23rd. Next week, I'm going to go into some current topics. The week after that, but probably before we get to the Monday, I will not release a video, but will release a weekly overview that essentially is the final exam review, which was similar to what we did for the midterm. One student asked about whether the final exam will be cumulative. The focus of the final exam will be the stuff we've worked on since the midterm exam. I won't go back before the midterm exam to look for specific material. However, a lot of the stuff we've done since the midterm exam requires knowledge of things we did before the midterm exam. So just keep that part in mind. But the focus certainly will be those things we've covered since the midterm exam. Really, the big ones that are more complicated, zero knowledge proofs, and this Microeconomics of Cryptocurrency paper. And we also covered Corda, a permissioned network for banks. But then we sort of put those things together when we thought about zero knowledge proofs, getting some of the benefits of a permissionless system, but also some of the benefits of a more protected system, more protected privacy. All right, I will see you guys next time.